Welcome back to DataBytez, your number one source for data-driven content. Today we are diving into one of the most critical aspects of financial literacy and investment, the 4 core financial statements. These documents are the bedrock for determining any organization's financial health, and knowing how to read and interpret them is essential for anyone looking to make sound financial decisions, whether for a business or for personal investments. By the end of this video, you'll not only understand these statements, but appreciate why they matter and how to connect to the broader financial picture. So let's dive in. So starting with our agenda for the day, this is kind of the roadmap that we're looking at. We'll start by defining what financial statements are and their purpose. Then we'll break down each of the 4 financial statements: the income statement, balance sheet, cash flow statement, and statement of changes in equity, sometimes called the statement of owner's equity. We'll learn how to read them and discuss why they are vital to your financial success or financial success in general. So, what are financial statements? Financial statements are essentially a snapshot of a company's financial health. Think of them as a business's story told through numbers. They show how much money is coming in, where it's going, and how much is left. For public companies, these statements are legally required and publicly available, making them invaluable tools for investors, lenders, and stakeholders. But make no mistake, all businesses depend on their financials. They are the foundation for decision making. For example, if the business you are thinking of investing in is operating at a loss, chances are you shouldn't invest in it, even if Wall Street thinks it's going somewhere. So, financial statements are important in order to understand the financial health of any company out there, whether it be your own or whether it be one you're investing in. This is particularly important for anyone who has entrepreneurial aspirations. You should know how to read the financial statements so you can monitor how your business is doing. So, going to our first financial statement, the income statement, measuring performance. The income statement is also known as the profit and loss statement. It measures revenue, expenses, and profit over a specific period. The formula here is revenue minus expenses equal net income. And key sections include revenue, cost of goods sold, also known as COGS, operating expenses, and net income. Fun fact, when I had my first accounting job, I was really confused when people talked about a P&L. When I was taking classes, the professor taught everything about the income statement. Income statement this, income statement that. But when you go into the business world, people just say P&L, profit and loss. So that was something that really confused me at first. The general structure of the income statement is that it starts with revenue, aka how much money the business has earned. Then it subtracts expenses like cost of goods sold, operating costs, blah, blah, and it gets to net income, which is the bottom line. And everyone always cares about the bottom line. The income statement is the first place most investors and business owners look because it answers the most fundamental question of business. Are we turning a profit? Is the business profitable? If your business is not profitable, you got some real problems ahead of you. So our next financial statement is the balance sheet. The financial position snapshot. So the balance sheet shows assets, liabilities, and equity at a specific point in time. So while the income statement can show a ranging period of time, months, days, weeks, years, the balance sheet shows a specific point. It's like taking a picture. Whatever happened at that specific moment, that is what the balance sheet shows. The formula is assets equal liabilities plus equity. This is the number one formula in accounting. These things must always be inequality. They must always be equal to each other. Assets must always equal liabilities plus equity. Key sections of the balance sheet include current assets, fixed assets, current liabilities, long-term liabilities, and shareholders' equity. Going a little bit more into this, assets are what the company owns. These include things like cash, inventory, or equipment. Liabilities are what the company owes, like loans or accounts payable, or in other words, bills due. And equity represents the owner's stake in the company. This could be a group of shareholders, this could be a single person. Whatever the case, it is the stake that these owner has in the company. Again, the balance sheet must balance. It must live up to its namesake. So again, assets must always equal liabilities plus equity. And it's kind of like a double check to ensure everything adds up. A balance sheet is never allowed to not add up. But if it does, chances are there's something actually wrong with the accounting software. In my life, I've never seen anyone actually mess up a balance sheet through entries. But of course, I guess it could be possible. I guess someone could be very creative with their accounting and ruin the balance of the balance sheet. But generally, this means there's something wrong in the underlying data of the accounting software. Probably something got corrupted, because a balance sheet is never allowed not to balance, and it cannot be allowed. And now our next statement is the cash flow statement. The cash flow tracks the cash inflows and outflows during a period. It is divided into operating, investing, and financing activities, and helps assess liquidity and cash management. Liquidity is equal to how much cash. When someone says a company is liquid, that means they have cash in the bank. When a company is illiquid, it means they do not have enough cash in the bank to maintain operations. So while the income statement shows profitability, the cash flow statement shows liquidity. How much cash is coming in and out. Those three sections, what we discussed, the day-to-day operating activities. This is what is cash that is generated from the business operating in its main activity. So if you're selling ice cream, your operating activities is the sale of ice cream, how much ice cream you're moving. So if you're selling a bunch of, what's a fun one? Drumsticks. I don't know if people still find drumsticks delicious, but if you're selling a bunch, how much cash are you generating from the sale of drumsticks? Investing activities. Sometimes companies do invest because they have so much cash they don't know what to do with. So how much are you getting from those investments? And then financing activities. If a company loans out money, how much money is it making, or receiving loans? How much money is coming in because of their taking loans or they're giving out loans? Now, this statement is actually very critical. All the statements are important, but cash flow has a special importance because it doesn't matter if a company is profitable if it is cash poor. Now, you might be wondering, how can a company be profitable and cash poor at the same time? That seems contradictory. Well, that comes down to how effective a company is at collecting its receivables or the money its customers owe. This isn't really an issue with business to consumer or B2C business models, because B2C is basically you, me, whoever goes to a store and try to buy something. We aren't allowed to walk out with the stuff. We don't get what we want unless we pay for it at the register. So the receivable is always collected at the time of sale. So the company doesn't really have to worry about people not paying. However, this is much more of a problem in business to business or B2B models, because businesses often extend each other lines of credit, which is different than when you get a credit card or you get a loan. Well, kind of like a loan, actually. One business will say, hey, we'll allow you to take 30 days to pay a bill, or 60 days or whatever it is, and we'll give you the ability to accumulate, X amount of bills before we put a stop on services. And this usually I've seen the most cause a problem with manufacturing if your business is involved in manufacturing, because you will probably start the order of what your customer is requesting before you get paid. It's kind of usually how it goes. So you get, say, one of your customers say, I want 10,000 lids. Give me 10,000 lids. And it's going to cost you that invoice. You'll invoice them, let's say $50,000. It costs you $30,000 in materials and all that stuff. You ship it out to them. And then they're like, you know what? I don't know if I'm going to pay you. And so you've lost the money, labor, materials, shipping, the logistical costs, but you are not collecting that money. So you are profitable. The sale was profitable. You would have made money, but they have not paid you. And it might take a while for them to get that money to you. And meanwhile, you still have to pay things like payroll. You might have other things to pay for. Maybe you took out a loan to get the equipment and that loan needs servicing, meaning you need to pay the monthly payment. And so you could still be profitable and default, not have enough cash to get by because you are not collecting the receivables fast enough. So having a structure, a business having a structure where it is able to effectively collect receivables, not have too many outstanding, is actually very important. So profitability means nothing if a business is not receiving cash. You must remember that. And it's the reason why the cash flow statement is so important. It is the only way for you to really look into see if the business is generating cash. And you can also see things that wouldn't show up necessarily as effectively in the, or I guess not as clearly as it would be in the balance sheet. Like, are they collecting a lot of cash due to loans? Of course, you would see it as a liability on the balance sheet, but you can just see how much cash is being coming in and what is going out. Maybe potentially how much is draining, whatever the case. But cash flow statement, extremely important. So next, our final statement is the changes in equity, tracking ownership. That is what this statement is for. It shows the changes in owner's equity over time. This includes retained earnings, share issuances, and dividend payouts. Help stakeholders understand equity dynamics in the business. Now, the statement is less exciting, but it is important to see how a company manages its profits and capital. Is it reinvesting profits into the business? Is it paying it out to owners in terms of distributions? All of this will be made much more apparent in this statement of changes in equity. Now, I'll be frank, at least in my life, I haven't really had to deal with this statement too much. Everyone cares about cash flow. People care about profitability. And people care about, how many assets they have, liabilities, and all that stuff to do analyses. But at least in the private world that I've operated in, no one really cares about the changes in equity. Owners kind of know what's going on based on how much money they're getting. But this does play a role if you want to do a big public company, because public companies have shares distributed to you and I, to institutions. So the statement of equity changes actually is much more important. Public stakeholders need that kind of transparency in the business to see where this money is going, how much it's paying out. Potentially it's paying out too much, right? And that could also be a problem. Something recently, at the time of this recording that was kind of recent, was where Elon Musk actually had the court block his payment package, saying that he was getting paid too much from Tesla specifically as its CEO. So again, that would be something in equity, right? The business is paying out some of the profit or would be profit to Elon Musk, someone who has a very big stake in Tesla itself, as it's one of its, I don't know if it's how much share he owns, but I know he owns a good chunk of shares. And so they said this is too much for a CEO and for someone to have so much of a position in the company to be paid. And so I blocked it. I think they're still fighting it in court to this day. I don't really know what the situation is, but it is a good example of the public, the institutions that monitor these businesses, especially the publicly operating business, publicly traded businesses, look into these financials and see how things are working out, and it plays out in real life. So now having introduced the 4 core financial statements, we get to the kind of part that we like to look, though I guess the more exciting part, which is how to read financial statements. Now, reading financial statements is about seeing the bigger picture. You're looking for trends over time rather than focusing on a fixed period. Just looking at 1 year is not good enough. You want to look at multiple years. You want to see trends that evolve. And so this also lends itself to businesses that have been in operation for a bit, where you can actually look at the historical data to see how things are turning out. You also want to use financial ratios to evaluate profitability, liquidity, and solvency. So ratios like the current ratio, profit margins, and debt to equity. For example, a declining profit margin might signal rising costs, while increasing debt to equity ratio might mean the company is taking on too much debt. So looking for those red flags is important. You want to be keenly focused on something when something bad is stirring in the financials. Now, you don't want to be skittish, because sometimes you lose out on a good thing by just a momentary thing that might be bad, but looking for trends, looking for a continued decline is actually pretty important. Just 1 quarter of down sales might not be bad, but 2, 3, 4, a whole year of declining sales, that might start saying like, hey, I think there's a problem here. Maybe the business is no longer competitive in the marketplace. And maybe that would require you to make adjustments. Maybe you pull out your investment. Maybe you sell. Maybe that's the decision you want to take. But the important part is you're not just looking at a specific time, because, maybe sales went down for the week. Who cares? Maybe sales went down for the month. Whatever. But again, you start seeing sales go down for the entire year, maybe you have to worry. Unless it's a whole thing that in the market itself is just depressed, which you would also consider. The whole market is depressed and not operating where it should be, then you wouldn't necessarily be skittish about it. You'd just be like, yeah, that's just what it is. So, why do financial statements matter? Now, we've touched on this a little bit, but the reason why is because they empower decision making. Whether you are an investor deciding where to put your money, a lender evaluating a loan application, or a business owner planning for growth, the financials provide the answers. They also promote transparency and accountability, which are essential in our modern financial system. The financial system cannot exist without trust in the transparency of financials. That is why it is that is why it's such a big deal when companies falsify their financials. It is a big problem when it happens, because it erodes the trust in the system. Now, our system is not perfect, but at the very least, we can trust that the financials that we are getting are accurate. And this is, again, before moving on here, if you plan to run a business, you really need to understand how to read financials. You will save yourself heartache instead of relying on other people to read them for you and interpret it for you. Yes, there are people that are trustworthy out there, but it's always good when you can do it yourself. It doesn't mean you have to know how to do accounting in and out, but just being able to read it, just like you're able to read a book. You don't need to be a great writer to read, right? We can all read a book. We can all read an article that comes online. Just being able to read the financial and understand what is happening is very important. It helps you from getting the wool being pulled over your eyes and people lying and saying, oh, this thing happened. You're like, oh, yeah. So I think Benjamin Graham, puts it best when he talks about it. Not to go too far off topic in the details right now. This is more of an introduction, but sometimes companies, because they don't want to look bad, they will put losses under something called extraordinary loss, and it's supposed to be things that are due to maybe an act of God. So something like a flood or a fire or a tornado, and these things are not common losses. They are extraordinary. They are outside of the ordinary expectation of loss that a company has. But when they keep putting it on there, right? A company keeps putting year after year extraordinary losses. Is it really extraordinary anymore? anymore, right? Is it really? It sounds like it's an ordinary loss at this point. It should just be putting under there, just under ordinary expenses. But they won't say that because they want to make it seem like they are normally profitable. There's just something happening and they'll explain it away. So that's something that if you're not really in tune with being able to read and interpret financials, people can take advantage of you, and they will, because that's just how they roll. Companies want to be seen as strong, and they will do whatever they can to do it because they want their share price to go up, their stock price to go through the roof, because it makes them money. And it makes the shareholder money without actually creating value. So in closing, we have reached the end of this video. The 4 core financial statements tell a company's financial story. Learning to read them equips you with valuable decision-making tools. And you should use them to assess performance, position, and prospects. PPP, everyone. So, I know we didn't really look at each financial statement, like look at one they report. I think that would have gotten a little bit too long and beyond the scope of this. I just kind of want to introduce what the financial statements are, why they're important, how to read them, which again, you're looking at them not just at a fixed period, but you're looking for trends. You're not looking at a specific point in time, you're looking at a long point in time. Usually you get access to you don't get access to a company's accounting software, but most of the time they'll post it up, especially if you can buy stocks in them. So downloading multiple years worth of financials and being able to do that kind of trend analysis yourself is important. And we actually will do that at some point after we build up enough knowledge here, so we can actually so you can follow along without feeling completely lost in what's happening. And we will actually look at what these financial statements can look like and how to conduct a certain type of analysis based on what is called value investing, which is actually part of what trained Warren Buffett to become the very successful investor that he's become to be. And this is based on the teachings of someone called Benjamin Graham, an economist. I am getting ahead of myself, but it's just because I think it's important. And it's an exciting portion I'm really getting to hoping to get to with you, because I think value investing, the methodology behind it, the analysis behind it, will help you all avoid devastating loss and make money in the long term. But again, that is all. Join me next time. We should be covering financial ratios. We touched on them here, but they are a quick way to get key metrics from the financial statements and get a better understanding of the position of a company. Not just looking at a sole number, but looking at how numbers work together to really form the fully flesh out the story. It should probably be somewhere on the screen, somewhere. I don't know. Maybe not. Maybe I'll forget. But if you see it, click it. If not, find it. You'll see it soon. Stay tuned. As always, it is Patrick from DataBytez. Hope you all have a great rest of your day. And as always, stay data driven. Till next time. Bye-bye.